Hello, everyone. This is Sean Spalding. I am your instructor for Financial Accounting, Business 120. Today we are going to continue on with a brief lecture on adjusting and closing entries, which is part of Chapter 3, also Module 3 here in Canvas. Essentially, this module is broken up into two parts. We've got week 1, which is this week, and then next week we'll close it out with the other two learning objectives. So the learning objectives are understand the revenue recognition and matching principle. We'll talk about those GAAP principles. And then we'll move on to understanding the 4 types of adjustments to prepare the adjusting entries. So real quick, this is a kind of flashback to Chapter 2, right? This is another look. This is a really important graph to kind of put everything into perspective for you of what's happening with each step. We go through, we journalize, we post to the general ledger or the T accounts as we use them. And then we move on to the unadjusted trial balance. And then if the business requires adjusting entries, we make the adjusting entries, and then we create a new adjusted trial balance. Then we prepare our financial statements, journalize the post and post-closing entries, and then we prepare a post-closing trial balance. Okay, so those are the accounting steps that we take in each cycle. Okay. Now, an accounting period, and I've touched on this previously, but the accounting period can be anything, right? It could be a month, it could be a quarter, it could be a year, it could be a week, whatever the case may be. Most large companies, as you see here, have their accounting period as a calendar year, so January 1st through December 31st. And then some will use the fiscal year. Now, a fiscal year is just any consecutive 12-month period. So you might see like the government, I think the federal government's fiscal year is I think it's October 1st through September 30th. Something like that, where it's not the calendar year. So that's basically what a fiscal year is, any other 12-month period that's not a calendar year. So pretty straightforward there. Now, understand the revenue recognition and matching principles. These are pretty straightforward, right? Before we get into those principles, we'll talk about accrual accounting. Now, in the book, you will have read about the accrual accounting method and the cash accounting method. Accrual accounting has to do with recording the revenues earned and the expenses that are incurred in the period. So we're trying to get it in the correct period of time. Whereas the cash method of accounting is just looking at when the money is received or when the money is spent. So basically when the money is actually passing from one hand to the other. Now, as you can imagine, that leaves a lot of room for inaccuracy, right? So one could, for example, I'm just pulling from kind of my tax background, a cash method business may spend a bunch of cash at the end of the year on things perhaps that are prepaying or they're getting ready for the next year. And so on their tax return for that accounting period, it looks like their income is lower than what it actually is because they're spending this money. They're kind of prepaying expenses perhaps. So again, accrual accounting is the required method of accounting for GAAP purposes, but a lot of small businesses will still use cash accounting just because of the simplicity of it. But so that's, again, the general idea is that we're kind of trying to get the income matched with the expenses. And so that moves us into our principles, right? We've got the revenue recognition principle. So we're recording revenues when they are earned by providing goods or services to customers. So sometimes the customer may prepay us. They may pay us a lump sum, but it takes us maybe the contract's a 3-month contract. And so we get $3,000 to complete the 3-month contract. Well, that means we've got $1,000 earned after month 1, $2,000 earned after month 2, et cetera, et cetera. Instead of saying, hey, we've earned $3,000 because we haven't completed the contract yet. So it's more accurate to break that up into the appropriate amounts per month in that particular example. And then the matching principle just has to do with the expenses associated with making that money, so that just to use the same kind of example, if we prepay rent for 12 months and we pay $12,000, well, our expense wasn't $12,000 in the day that we paid it, right? It's going to accrue over that 12-month period because we've prepaid it. So after month one, that's $1,000. After month two, it's $2,000. So it may be necessary to make those adjusting entries to get that to be accurately reflected. Okay, adjusting entries, right? And this is just what we've been talking about. So at the end of the period, an accountant will prepare the trial balance, right? And before they can prepare an accurate, up-to-date financial statements, the accountant has to prepare the adjusting entries. And adjusting entries are the journal entries that are made at the end of the accounting period to measure the period's income accurately and bring the related asset and liability accounts to correct balances before the financial statements are prepared. So it's about accuracy, right? Okay, now, understanding the 4 types of adjustments and prepare the adjusting entries. We'll talk about this briefly, and then we'll go into a few examples. But we don't have to get hung up on exactly what these are for our class purposes. We just have to understand that what we're trying to do is accurately reflect the money we've collected for services and expenses and perhaps depreciation for assets. You'll see that in there. Wages, as far as the expenses go, may vary because of the pay periods. And again, we're just trying to the extent that it's all material, meaning that it has an impact, perhaps that would affect a potential investor's decision to invest in the company or some other third-party actor from acting. That's when it becomes material. So for small businesses, sometimes, arguably these things aren't material, how it's accounted for. But we'll learn how to make the adjusting entries. They are definitely important for large companies. And so we have adjustments for accruals. So here we accrue or record unrecorded revenues and unrecorded expenses. And then we have adjustments for deferrals, dividing unearned revenues between periods, dividing prepaid expenses, supplies, buildings, equipment, and other assets between periods. So this is what we've been talking about. And then we have unearned revenue. This is a liability created when a business collects cash from customers in advance of providing goods or services. So again, using my example, they pay us $3,000 to complete a job, but the job's going to take us 3 months, and they pay us on day one. Well, we have unearned revenue there because we haven't earned it yet, because we're not going to earn it until the end of the 3rd month. And so this is also called deferred revenue. And then prepaid expenses, these amounts, they create an asset, right? We've prepaid for our rent, for example. So we have a $12,000 asset. If we pay $12,000 for a year, and it's $1,000 per month. Okay, and this is referred to as a deferred expense. Okay, so now the unadjusted trial balance. So we've talked about this here briefly, right? You have to create the trial balance based on the initial entries. This is before any adjusting entries have been made. And then we make, so we're taking a look at it, pretty straightforward. And then we have to go through the process of accruing revenues, for example, accounts receivable. And here we're going to go through a couple of quick examples. We're just going to talk about accounts receivable, and then we'll go through one with salaries as well. So businesses sometimes earn revenue by providing goods or services before they receive cash. So here we say Bold City Consulting Inc. is hired on March 15th to provide ongoing consulting services to a new client. Bold City Consulting agrees to a monthly fee of $1,250, which the client agrees to pay on the 15th of each month, beginning April 15th. Assume that during March, Bold City Consulting earns half a month's fee, $625, so $1,250 divided by 2, right, for consulting work performed March 15th through March 30th. So now we have to make our adjusting entries. So on March 31st, Bold City makes an adjusting entry to reflect the accrual of revenue earned during March. And so that's going to look like this. So we've got accounts receivable. We have accounts receivable going up, $625. Accounts receivable is an asset. Assets go up with a debit, right? And then we have service revenue going up. Revenue goes up with a credit. And so we see this entry being made into our journal and then posting it to our T accounts or our general ledger. which will give us our adjusted balance there, which we'll use to make or prepare our adjusted trial balance. Okay. So same thing with salaries here. So we've got salaries as an accrued expense. They're expenses that have been incurred before being paid, right? So suppose during March, Bold City Consulting makes the office assistant a full-time employee and agrees to a monthly salary of $1,350. Bold City also decides to pay for the current month's work on the 10th of the following month. The salary earned by the assistant during March will not be paid until April 10th. Therefore, at the end of March, they've really accrued an additional expense that just hasn't been paid yet, right? So how does that look? So we have to do the math here, and we've got a salaries expense of $1,350, right? So not really making us do any math. That's the entire expense. But we have to record it on March 31st, not on April 10th when it's actually paid. So the way it would be reported is salary expense. Expenses go up with a debit, so $1,350, and our expense is going up. We're incurring an additional expense for salaries. And then we're creating an account, salaries payable, right? Salaries payable sounds like a liability, is a liability. Liabilities increase with a credit. So that's pretty much what we're dealing with the adjusting entries here on Module 3, Week 1. Our homework is going to be based on this, kind of exploring the matching principle, revenue recognition, and the adjusting entries, adjusted trial balance, and things like that. So we get a grasp of that so that we can move on to kind of the final stages of the accounting cycle. Again, if you have any questions, feel free to reach out to me via Canvas or email, and I'll get back to you as soon as I can. All right, thank you.